All right, good morning, happy Wednesday, happy hump day. Please give me a second here. I got to just get all the little things set up. Un momento, por favor, but happy trading day. All right, here's the link. Now I got the chat going. Okay, that's important. So now I got the chat. Hang on, almost done. Patience, grasshopper, patience. Almost done. Wait for it. But anyways, good morning. You look good. Holy smokes, eh? You losing weight? I'm still gaining weight for the winter. The winter's over. All right, 2 more seconds. All right, so we got that going. Oh, you know what I need to do? I need to go over here. I need to push that, and I need to go there. Cool. All right, so I think we're golden here. Golden, everybody good? You're there? I'm here? Wait, I lost the chat. Almost. Let me get the chat back. I gotta bring that over here. Gee whiz, so complicated. Chat. Where's the chat? It's gonna be here. There we go. There we go. Good, right? Yeah, looks good, sounds good. All right. So happy day, everyone. It's a Wednesday. It's a hump day. Whoop, whoop, whoop. What's the big news today? Was it going to be FOMC? The meeting minutes? Yeah, I think so too. Great coffee. Hey, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. So please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Yeah. Jim, good morning. Hey, good morning to you. Oh, Jim, so you usually watch the recording, but today you want to do the live, huh? Boom. Thank you, Jimbo. Baltic Dry Index. Yeah, what's going on with the Baltic Dry Index? Human God's like, hey man, can we look at the Baltic Dry Index? You know, I generally don't get that from people. But why not? U.S. market PMIs. Yeah, Eternal Soul brings up the PMIs. Well, they're pretty disappointing out of Europe again. So if you recall, just gee whiz, what, 3-4 months ago, the news out of Europe was quite impressive. Things were going really well there. There was talk of, the ECB, starting to plan not just killing quantitative easing, but starting the normalization process for interest rates. And like, oh my gosh, remember how I was buying Turkish lira and making money? That was 90 days ago. That whole scenario is over. It's done. Europe's sinking. Bloop, bloop, bloop. Like it hit an iceberg about 3 months ago, right? Right. So that's bad, right? Also, we were using Turkey as the canary in the coal mine for European confidence, right? European market confidence. And wow, the Turkish lira just hit an all-time low. An all-time low. Now, put this into perspective. About 3 months ago, I was buying it and making money. And then I'm like, I stopped doing it. I'm like, oh my God, something went weird. And I got out of that whole process. And, well, good thing, right? So something's happened. And part of it was ECB or Draghi specifically talking the euro down. But the PMI numbers are bad. And there's a lot of numbers that have just been bad out of there. So a great opportunity. Like, it's not just the 10-year T-note in the United States of America paying 3%. We talked about that being important. But the other half of the coin is, Europe sucks, right? So they're going to give socialism a try again and see if that works. Yeah. Yeah. Well, it worked for all of Latin America, right? All we are saying is give socialism a chance. Hey, speaking about the end of socialism, hey, rolling back some Dodd-Frank regulations. That was announced today. Probably the Farm Bill was passed. For some reason, they throw that stuff in the Farm Bill. I just caught a glimpse of that today. But so I don't know what they're rolling back, but that could be very interesting. What happened after the financial crisis, in true government fashion, instead of helping, they decided to go from no regulation to over-regulation. So maybe they're kind of fixing things, smoothing things out. Okay, so that's cool. And by the way, the U.S. banks made $56 billion in profit in the last 3 months. Good to be a bank. Okay. So anyways, down, 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 down. We're going with the euro. We're now at 117. Blah, 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 blah. So what do you want to do, huh? Blah, 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 blah. Couple of things going on. Remember, this was our target, this whole gray zone. This was supposed to be the low, the projected low. Not supposed to. The projected low for euro dollar for the month of May was basically, what, 118, right? And then yesterday we had this scenario of lower low, lower high. Let's get rid of the fibby. Okay. Actually, I wanted that. Important. No. I wanted the channel here. I think I had it like this. All right, good. Okay. Bottom, 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 all this kind of stuff. But the important thing for the bears that wanted to remain a bear and be aggressive, okay, there's the entry yesterday. Okay. And this was pretty clear yesterday. Again, imagine if you were a bull and you had 2 places you wanted to buy. And imagine if you were a bear and you had 2 places you wanted to sell. Some of these, are pretty obvious. Not fairly obvious, quite obvious, right? Things like using the resistance again. Down, 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 down. Also, the reason I have this channel here is channels are great to identify breaks and pullbacks. Okay, and a bear can confirm their downtrend move by having an up channel break. Okay, breakout, pullback, long and gone, or short and gone, right? Now, a bull on the other side would be looking for a bounce here, never got it, right? Probably looking for a bounce here, right? All this kind of stuff. Okay. But as I think bears would have or should have really had that. That's what makes sense. Or you went neutral and then waited for a break to go that way, right? Have you thought about that? Like, if you're a bull, then what would you look for? Or if you're a bear, then what do you look for entering, right? Resistance and breakouts. Okay. If you were a bear in here, where are the places to sell? There's another way of looking at that. Okay. And you could take this across, so you got to sell there, you got to sell there. Even if it went up here, that might have been a sell up there. Okay. If you were a bull, what would you look for and why? Now, part of what a bull should be looking for to go from, let's say, cautiously long to confidently long would be a higher high against this high, right? Okay. But look how far back this goes, guys. Okay. And remember, this low here, the bottom of this X, I know I got so much printed on here. Let's just reset it. The importance of it is it went from support to resistance, right? I'm just trying to get this in here. This went from the projected low, and look, it held perfectly. Retracement, here's last week's swing, okay? Dipsy-do, up, into this old area. Again, I'll mark it like this. This is the projected low on the first of the month that we drew that X. So all that happened, guys, and so you might not have noticed it on a 15-minute chart, for example, but on like a daily chart or a 4-hour chart, the only thing that happened was we basically, how would you play it, like a low, a high, and the continuation. Okay. If you're a bull and you try to take that, you're doing your job. You took your shots, took your shots, took your shots. In fact, I think I was short US dollar yesterday and made money. But the dollar is strong now, right? So fine. If you're long dollar, which is what the trend is right now, then that's a fairly, those are fairly obvious places to buy the dollar. So it really comes down to, if you're trading a bias, you had opportunities to trade well in either direction. You would have made money or could have made money in either direction, whether you're a buyer of dollar or seller of dollar. It's just whoever bought dollars will be making more money today. Okay. So anyways, let's go. What was I going to do? Oh, pig. Let's do pig. Okay. Okay. That's it. We're now approaching. We're within just, let's say, 15 pips of the projected bottom for the pound dollar. Okay. You see what I mean? So we're approaching a point where that risk is likely to increase, not risk of a reversal, but risk of further downward movement. It's one of these things where the trade plan on the first of the month, we found ourselves here. There's only two things that could happen here. Bulls buy off the pivot. Okay, that's very unlikely to have happened unless you bought it on the Friday before, or the last few days of the previous month. Totally worth the shot. You see there's consolidation there. They would have lost, I don't know, 25 pips or something, right? But bears are supposed to use the moving averages to sell down into this zone. So here we are on the 23rd of the month, and we have now fulfilled this to that. That's the moneymaker stuff. Okay, that's you punching your time card into the pip factory, sitting down. You're like, all right, bears over there. Okay, bears sit down and they sell the moving averages down, up, down. So here's what happened in the month of May. Now, if you're on a 15-minute chart, you remember it differently than this. But if you're trading a 4-hour or daily, that's the only thing that happened for the month of May. Right? That's that. Okay? The only other, if you were a bull, what you were hoping for is sort of this kind of move in the month of May. Essentially the opposite, right? So it would be a great idea to boil your trading strategies down to something as simple as that, right? That's called strategy, right? Your strategy should be mapped out. Really, you should be mapping out next month's strategy. You should be mapping out June now, right? Because in less than a week, we'll be on to June. So how would that have influenced you if you had this sort of mapped out at the beginning of the month? Well, you could have said, oh, very quickly after just really probably on May 2nd, you find yourself down here. So it's very clear this is the strategy that's in play. Now imagine your weekly pivots or imagine your daily pivots in here. Okay, that's more of a tactical move. Let's say you're day trading. Okay. Oh yeah, that's right. And I'm starting the process of building the day trading workshop. So in probably 2.5 weeks, we'll do that at Traders Way. So for all live account holders, I'll do a multi-day workshop on day trading. So we'll talk about things like this. So you start with the strategy here, right? And then you fold in your dailies. So imagine your daily pivots and you're trading purely tactically. And the reason I say it's purely tactically and not strategically is on day trading, you're probably not trading a fundamental bias. You're just trading, hey man, today is bearish, right? So I'm a bear. What I think most of you guys do is you start trading and you don't even have that. You're like, I'm not a bear today. I'm neutral. I can be both. I can be both bullish and bearish and bullish. Or even worse, like we were laughing the other day, right? You could be bullish for the next 3 minutes and then find yourself totally convinced it's bearish now. So you're like, oh no, I got to get out of my long. I got to short, right? And so that we got to fix that because even your tactics are a mess. But so anyways, we kind of have to fold that in. But imagine a bias set, right? That's your strategy. This is your strategy for May. What's the next move, right? And that comes down to your tactics. Now, that being said, we have a strong trend. Couldn't it fall down here? Sure, it can do whatever it wants, okay? But now we have to sort of measure. What if we actually did math? Oh my God, what if we did math? You guys good with calculus? You want to do some calculus? Okay, this is a function of something, 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 something. Okay, these pips here, from this low to that low. Okay, if you were to have some sort of mathematical formula, I would say these pips relative to these pips have a lower probability, or to say it differently, a higher risk associated with them. Okay, so shouldn't you trade them differently? Shouldn't you categorize these pips versus these pips? They're not the same, is what I'm proposing. A pip isn't a pip isn't a pip. Okay? So it's like there's only one bullet in the chamber. There's 3 bullets in the chamber. Doesn't mean you're going to die. But you might not want to play the game the same. Right? That's all I'm saying. So if the probability of the move from where we are now, and let me kind of zoom in. Okay? If the probability below this area is lower, do you want how do you react to that? Do you risk less, or do you want more in return for your money, or do you just purely scalp and just say, well, Arctic turtle type scenario where it pops down and pops back up really quick? I want you to think about it now. One of the things I've proposed in the past is you just take your money and you're done. Wash your hands, go eat supper, right? And you say, well, Wayne, then I would miss things like the euro dollar move. Where's that one, right? Okay. Yeah, but you would have been done 2 weeks ago. You could have taken the bloody geese. Yeah, you just would have been done. You're like, you would have left these pips on the table, but do you have to have those pips? Maybe, right? But look how similar the pound trade was, right? This is where we started the month. So you know it's not a bullish trade. So all you can do is trade it down, which you did, and then just have been done. Okay? So you have to ask yourself, especially when you're analyzing your trading, what kind of trade history do you want to show to a potential investor, right? Do you want the sort of the low volatility type situation, or the higher returns? Now, you may in your mind, or maybe in your reality, who knows, um, believe that this is a lot of money, but I have a feeling that more than a few people in the room may have lost money in this scenario. So what if this is a situation where maybe you find it inconsistent, but this is the consistency, right? Then if you avoided this, then you remove some of your volatility because you're kind of just grabbing the low-hanging fruit. Or you say to yourself, and this is okay too, I don't know how you want to play this, but you recognize this for the future. You burn this into your brain for the future. And you say, hey, Wayne, I want you to listen to me, Wayne. In the future, when we do blow through these monthly pivots, then I want you to remember, Wayne, to stay with the trend. Okay, I'm talking to myself. Do you get that? All right. Okay, Wayne? And you write that down as your personal rules of engagement. And then you never trade against it, is how you would do it. Or I guess you could always trade against it. What would that do? Is there one that's going to work in all scenarios? Does this always drop after a break of the monthlies? Does it always reverse? Well, with this case, you can say, well, it didn't reverse, so it can't be always. But does it always behave this way after a monthly breakout? No. But what if you always behave the same? Well, then in a scenario of let's say over 1,000,000 years, right? Or on the long term, what if it was 50-50? What if it was 50-50? Half the time it goes up, half the time it goes down. Well, and you say, well, Wayne, the last 4 times in some situations like this, it fell. But if I said, yeah, well, in the last 4,000 times, right, it's one or the other, but over the long term, it's unpredictable, right? Well, it's 50-50. So what if you always behave the same in situations that are 50-50-ish? Then you become very consistent. You would have bought this and broke even, right? Maybe you would have bought this and made some money, and then it keeps collapsing on you. Okay, so you control your behavior so that your response to an inconsistent market is a consistent response. Therefore, you can do things like measure your success, but also manage your risk and lower your volatility, because even if you're a buyer here and you're wrong, you're still buying at good support. So it's still likely to give you green candles. And then you say, wow, but I'm buying a drop, so I better jam my stop quickly, and it protected you. And you tried it again, a good entry here, and it went up, and you jammed your stop. But you can see it still went up almost 100 pips, right? So you're still maybe making money. Or the opposite, you say, look, if this blows through the target, which is the X area, the gray area, if we blow through it, there's something incredibly strong about the trend, so I'm going to stay with the trend. Does anyone here know what I call that in regards to a daily pivot? If these were daily pivots and not monthly pivots, does anybody here know what I call this type of trade where you blow through the target? Does anybody know what I call that? This is old school stuff. Yeah, moo trade. Thank you, Brooke. And that advice comes from someone who asked me 10 or 15 years ago, Wayne, what do you do when price blows through your daily target using pivots? And I say, well, there's something very, very, very unusual going on in the market. Whatever it is, maybe it's news, maybe it's something else, but something has really made this market incredibly bearish or incredibly bullish. And the last thing in the world you want to do is fight against it. It's like swimming upstream into a tsunami. It's just pointless. You're going to die, right? So how do you handle that? And I said at the time, you just keep, right, in this case it's bearish. I told that person, well, in this case, you just keep selling until the cows come home. The cows come home, by the way, to eat. They come home I don't know if you know cattle, but they come home at the end of the day, right? So basically I said, look, if you blow through your daily pivots, you keep selling for the rest of that day, but you certainly don't look to buy, okay? So maybe you write this down as a rule of engagement. It's up to you because, again, it's probably 50-50. But how you behave should be 100% one way and 0% the other. So you could say under these circumstances, you only sell or you only buy. You only trade the breakout kind of thing, right? And then you cross this back over and now you're on pound. Well, in that scenario, you say, okay, good, book your profit, let it break out. So it'll probably drop a little farther. Who cares? Okay. What you're hoping for now, and let me zoom in to make this a little bit easier. Okay. So what you want to do now, if that is your rules of engagement, you want to let it break out and to say, okay, we've made a lower low through the monthlies. You're going to wait for a retracement, and then you're going to sell, and you're going to keep selling. More importantly, you're not looking to buy. Is that always going to work? Even though I just showed you on the euro dollar, it seems to be working. No, it's not always going to work. But if you see a breakout retracement and goes back to this pivot area and then starts to fall, so on a 15-minute chart you sell, you're probably not going to lose a lot of money. You probably will actually make money, even if it does this. But the thing is, I want you to behave the same. This is going to protect you on the long run. You cannot be making decisions on the fly. The market's unpredictable, but you should be consistent. You can't control the market, but you can control your behavior. Okay? So I don't want you making decisions like, oh, I don't know what to do here. I guess this time I'll do this. And then you make a different decision next time. Well, next time I guess I'll do this other thing. You'll never find success in your trading because you don't have defined rules of engagement. You don't know what you're doing. How can you possibly identify your strengths and weaknesses as a trader if you're random? How can you ever have consistency if you're random? And how can you ever be confident if you have no consistency? Because without the consistency, there's no control. Without control, you can't measure anything. And you can't say, well, after trading a monthly breakout like this, over the last 3 years, I saw it happen 14 times. And of the 14 times, I traded in the direction of the initial breakout. And in those 14 scenarios in which I traded in the direction of the initial breakout, 8 of those times I made money, and the other times I broke even. So when it happens a 15th time, you have confidence. Because you're like, well, most of the time I make money if I just keep trading in that breakout. And why do you have the confidence? Because you have the control, and you have control which produces the consistency, so therefore you can measure it. And now you can say, oh, I'll probably make money here because I know exactly what to do. I have rules of engagement. And when it doesn't work, it doesn't hurt. Okay? Kiwi dollar? Yeah. I was watching Kiwi move yesterday. It was pretty interesting. Do I even have Kiwi dollar up here? I don't think I must somewhere. No. Oh yeah. There we go. Oil. Yeah, I can look at oil. In my life, hold it big. So it looks like a hard-fought reversal. So where in the world are we? So somebody said, we hit our monthly target. I wonder if we can put together a reversal pattern. And if so, what would the reversal pattern look like? Double down. Look how beautiful this is. I even drew it with triangles. You guys remember doing this? Then here's your 1, 2, 3 reversal, right? 50% predicts 1382, which is actually our top. It's amazing. All right, so this 50% predicts the top here. So this spot here predicts the top is going to be the 1382. Wait. Let me not get ahead of myself. We have two fibs going on. All right, well, let's see this. That drop predicts the 1382, which is here. Looks pretty good. Thank God I put that in my book. All right. Let's just kill everything. Okay, so that gets us there. And then you can measure this. And the 382 actually predicts the 1618, which we didn't get, which is kind of a, well, kind of tells us maybe that's not who was fibbing. Yeah, so this 50% predicts that 1382. Okay, so we know there's smaller time frame traders trading this because of that. Okay, so they're going to try it a third time. Why not, right? And where's our bottom? I guess we'll pull that bottom. Big break, refib it. 786 predicts the double top and a collapse. Cool. So there's your short-term price action. And now, what is it all? How does it all add up? Okay. Well, let's do it this way. Come on, Bubba. That actually predicts a top or weakness is what it's suggesting. Do you know why I say that? If it was so bullish, okay, if it was extremely bullish of a market, it would have done this. Okay, that's what you'd be looking for if you were extremely bullish. If you were modestly bullish, okay, you would expect this. Actually, and that would have changed it to this. Well, no, this. Okay, 618 predicts a 1382. I'm not making it up. That's actually my rule. All right, but this happened. Okay, so typically, like this other one that happened, like this macro move, it predicts a top. It shows weakness. Because of that, okay, I only anticipate 100%, maybe the predictable top is 121.4. Okay, maybe. But it often just tells you it's topish. So look, this one didn't work. It went higher, but it's showing you that this was pretty bullish. This was not very bullish. This took off, but it's still not very bullish. There's something, something propelled this up that probably shouldn't have been, or maybe it's new information. Well, in that case, you still would have then what? You would have fibbed that, right? And once again, if it was so bullish, you would have bought it. This is actually quite a good buy right here. You see this one? That's actually a really good buy. That's a beautiful buy if you bought that. You lost money or failed, right? Look at the, all the news, how it affected that. But it collapsed on us, right? So we had like a good move, not so good move, a breakout, but an ugly breakout if there was one. You had one chance here, and now it's all collapsed back around. Okay? But that's the kind of stuff that happens when you're buying a falling knife, when you're catching a falling knife. Okay? Reversals are generally not clean. Do I have these rules in my book? Yes. Okay? So, okay? Right? So now what? Who's in control? Are the bears in control? If so, where are they creating these trade plans from? Okay? This is somebody's 618. Like I just marked it. You see that? Based on this top, this is a 618. Are they in control? Then what would they be planning here? They want it to drop here, right? Then they're going to fib that. Then they're going to sell this. Then they're going to go for their target. Okay. Do we know that as a fact? No. There we go. Let's get rid of that. It's all part of planning. So now you got the reverse fib set up. So now you have to put yourself through an if-then scenario. What does it all mean? Gee whiz. Come on, Wayne. Okay. All right. So now you have all of this. If you're a bear, is this a good place to sell? No. If you're a bull, is this a good place to buy? You could think of it. You could be waiting on smaller time frames. Sure, absolutely, because you're going to play this out, aren't you? That's why it's not a good opportunity for bears. Okay? Because somebody bought it here, right? Remember, we set this double bottom, higher high, higher low, 1, 2, 3 reversal pattern, right? Someone is buying this. So if they were buying again, this would be an acceptable level. Okay? So that means if you're a bear, you have sort of two things going on. You let it break out, let it pull back, and you're going to trade there short. Or it rises to another level up here, and you sell that. Or some other sort of combination, right? So you put those down. Those are your trade plans. And if you're a bull, you buy it here, or you buy it here. And you see how inevitably the bulls and bears actually end up working together. Because the bears, they feel more comfortable if the bulls get out and it falls. Bulls try again here, and then the bears sell against them and knock them out again. Right? Because obviously these are weak bulls. So you got your buy, sell, sell. Okay? Look how we set this up for the short. Ugh, beautiful, huh? Isn't that amazing? From the top of April to the bottom of May. That's a nice move. Okay? Notice again, going back to the rules of engagement, we opened out a position. So there's only a sell, and you're only using the moving averages. On the first of the month, you would have been selling at 70, and we just hit 68 or something. It's only a couple of hundred pips. It's only 69. It's only 100 pips. It's nothing. I got chunks of gone bigger than that. Yeah. Oh, and just to add that to that, what if you had rules of engagement set in place for a scenario that does this? Well, then you know you want to trade the retracement, breakout again, right? It's not set up to be very bearish next month, though. I can tell you that much. This is set up for consolidation, in my opinion. Here's something I haven't used in a while. Does anybody know what this EKG is? Boop, boop, boop. Sorry, ma'am, he's not going to make it. No! What is this? That is the US dollar index. Ooh! So dollar is fairly strong. So you're like, well, how does it, what's going on here? Is Kiwi weak? Or is dollar strong? So the dollar's done this since, again, stupid scumbag. There we go. The US dollar since May 14th, so about a week and a half or so, has done this. Fairly strong. It's tapered off a little bit. Okay. Gee whiz, did I do that again? I can't believe it. Well, I must be cross-eyed today or something. Okay. So the big question now is whether we're going to do this. And of course, right, if Kiwi isn't also gaining strength, then this should fall if you're watching Dixie. Okay, so you can see dollar was getting strong in this period, but the Kiwi is actually getting stronger. Isn't that interesting? Well, Eternal Soul says Kiwi acts like USD proxy. Well, it's a commodity currency. So that's kind of more of what's going on. All right. And by the way, if you're going to do some research on stuff, milk prices, dairy prices move the New Zealand dollar. So you might want to watch the Fonterra dairy, global dairy auction. Do you trade lactose? So I want to show you this. La da da. What do you think of this? I'll even get rid of that. You know what? Let's just start over. Let's start fresh. Let's go. I'll do that. Seems unusual, right? You guys make money on that one? Black hole sun, black hole sun. Yeah, amazing stuff, right? Crazy, right? So let's say this week, the Turkish lira fell more than let's say 1, 2, 3, 4, 5, 6, 7, 8, 8 months. Okay, the Turkish lira moved more this week than the last 8 months combined. Isn't that interesting? La la la, la la la. Boy, could have just made a living selling the lira, huh? Yeah. I was looking at it on a different, I think I had this set up. I had this, I thought it was yesterday. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. Yeah, must have been in here somewhere then. Yeah, I think it was this. So I missed this yesterday. I actually, I was working with my portfolio managers, and I said, hey, look at the lira. That's set up nicely off the 21. Oh, even the geese are laughing at me. Oh, I didn't buy it. I didn't buy it. See, I was actually selling dollar. I bought peso and I bought South African rand. Made like 2,000 pips, enough for a cup of coffee. And I threw the baby out with the bathwater. Boy, that would have been nice, huh? Because again, this is what happens in like a year. It could have been a good mood trade. Oh, we meet in the room. We meet in the meeting room. We hung out. I had my laptop outside. We were trading outside. I was smoking a cigar. I said, right? I also sent out an email to. Are you logging into the room? Because you were not there. We were talking about it. You were wondering why you don't log in. You click on meeting room. Wow, okay, then something's going on. Something's going on. So, did you click on the email link, or did you log in and then click on meeting room? I'm trying to figure out where it's going wrong. All right, so you're on the dashboard, then you click on meeting room. Is that right, Highlander? Or you just sit on the dashboard? Maybe that's where you're going wrong. Maybe you're just sitting at the dashboard waiting for something to happen. Huh. All right. Let's figure that out, okay? It's Mickey, right? Let's figure that out. I have a feeling you're just sitting on the dashboard. All right. So, yeah, let's figure that out, bro. Yeah, let's figure it out. I mean, all right. Yeah, by the way, I took profit. Oh, I took profit here yesterday. I shorted, I think the day before, I shorted right here. And here's the peso. Why did I short this one? Oh, yeah, weekly. All right, so I was short probably here. I probably shorted on Friday, right here. So you got the weekly and the weekly, and then I got out here. See, I'm wrong. Made money. So if you're a bear now, you still have that. Okay. Okay. Yeah, but Highlander, the room is not open, so you're not in the meeting room. I have a feeling you're just sitting in the dashboard. So you will see other people there, and you can chat with them, but they're probably not watching the chat if they're in the meeting room. The meeting room's not open, so you wouldn't be in the meeting room. You have to, on the left-hand side, there's a navigation set of navigation bars or whatever. And one of them is labeled meeting room. And when you click on that, you're in the meeting room. Anyways, we'll get that figured out. Gold, we got to do some gold. Let's do some goldy. Let's do some oily. We'll do oily first. Okay. Oil. Okay. So different rules for different types of traders. Let's kill this. Let's kill this. Let's kill that. All right. Bulls, you see this? Up, down, and up. Bulls had their shot and it collapsed. What's the next move? You see the bearish move? Breakout, pull back to the scene of the crime, right? Down. Now we're hung up on support. Well, you either believe this is consolidating or you believe it's trending. Support one I've never used as a buy. I know some people preach that. I don't think it's right, in my opinion. So I think if you're a bear, you're going to trade it like, let's say, most aggressively, you're going to treat it like this. Okay? Your second plan as a bear is to sell that. Okay? And as a bull, what I was trying to say is I don't buy S1. So if you were bullish, you would have to be trading some other support. And it feels like it's more like the bearish target. Okay? So what are you going to do? You got to pick one. All right. Let's do gold. Big dip, big drop. I'm going to reset my template. Gold. This was harder. On the first of the month, that says sell using the moving averages, right? This one would not have been easy. May have been difficult because what you would have wanted was this kind of move. Okay? And it's pulled back more than I think most people would feel comfortable with. Okay? So if you didn't stay short, I get it. If you got knocked out, I get it. Hopefully you tried again and got back in somewhere else. It's not ideal, but it never broke the 200. Okay? And sort of the technical plan, right, is still achieved. Perhaps your stop was way up here. I don't know how big your stop is on your swing trades, but any of my swing traders would have traded the move you see that I've drawn, but this pullback was a little too much. But if your stop was above here or above here, you would have been fine. Okay, the target was here, and check that out. It went, what, 10 cents further down? Okay, now you have to decide what you're going to do next. So let's say you're still a bear. You got resistance here. I would sell it around there if I was a bear. Okay, and your next move would be, let's call it S2. Okay, and if you're a bull, I think you're going to be better off. I mean, you could scalp it until, right, but the market isn't really bullish until you're like way above here. But even then you got this in the way. So if it wasn't trending down, okay, so like let's say you're a bull, I think what you should do first before you start going to town and buying gold, I think you want to see some consolidation first. Like this is lower low, lower high, lower low, lower high. It's still predicting lower low. At some point, wouldn't you want to see, like, let's say caught here, caught here, caught here, caught here, like at least a month of, let's say, no lower lows. What do you think? Before you get all bullish, okay? I mean, there's some good trades here if you're a bear, right? Down, 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 right into the moving averages. This is a classic sell. This is actually a classic breakout. Yeah, it's beautiful. So I wouldn't be aggressive buying this. This is the projected bottom for the month, though. So what it just tells me is, well, you know, maybe that's it for May. But if you're planning June, I think what you should probably do is look for this come back, let's say 1300-ish. And then you'll sell at 1300-ish. And your target's going to be 1265. 35 bucks. It's not that great, right? It might drop down to 1250, but we're talking June, right? Yeah, 96. It's great. Okay. As long as you were thinking all these different things, breakout, pull back, breakout, okay, it's going to pull back, look right, there's a monthly pivot, weekly pivot, psych level, okay, so just shy of 1300, stop is up here, 1325, and I'm going for 1250. Okay, so I have a request here for Baltic Dry Index, okay. Seems interesting. Hey, can I get a little thumbs up thing? Takes like just seconds, not even a second. Oh, I just lost internet. Wow, there you go. I lost you for a second. I lost you for a second. Well, I asked you for the thumbs up is what I asked for. It looks like it's lagging, a little bit of laggy. All right, Baltic Dry Index. No chart, huh? View full chart. Doesn't look like a very good chart. There we go, that's better. Okay. Brief hiccup. Everything's good. Yeah, I think it's just Bloomberg's such a drag. Thank you. All right. So a little history here. What is the Baltic Dry Index? The Baltic Dry Index has to do with the price of ships floating around the oceans of the world. And not just any type of ship, not passenger ships, it's not a cruise ship. It's not container ships where you see, container boxes on top of container boxes on top of container boxes. Not those ones either. These are the ones that are kind of like hopper cars on a train. They hold dry goods like iron ore, coal, wheat, okay, soybeans. And what happens is these things float around the world. Now, it's actually a really interesting thing. If you want to study this, there's actually a life cycle of ships. So when there's not enough demand, so like during the financial crisis, there's all these ships that are not being used, right? There's no demand. If the global economy, so again, go back to like 2008. We were down here. Well, this is 2016. This only goes back 5 years. Anyways, so this, right? So we were at a point where this was down at like 500, or actually 300. 300. The high on this chart is 2,300. There's a difference, right? So there's booms and busts, sort of thing. So imagine when demands are high for these ships, prices are high. And when prices are high, very often orders are made for the actual ships. Companies want to buy them, right? And then what they can do is they can build too many ships. And now you have ships not being used. So what there's a life cycle now where then those companies that do own the ships and actually do the shipping, what they'll do is they'll scrap their oldest, their least profitable, most expensive to run, least efficient rust buckets. They'll scrap them, and now you have only the newer, more efficient, better technology ships, right? That's the supply side. Most of the time, however, we're looking at the demand side. Okay, so go back to the financial crisis. China had slowed down. Australia had slowed down. Canada, New Zealand had slowed down. All of Europe slowed down. The United States slowed down. All their economies were down. Unemployment was high. Inflation was low. Productivity was low. And demand for things like iron ore and coal and soybeans and rice and wheat was low. Nobody was buying this stuff. There wasn't a need for it. Chinese factories were running at 50%. They didn't need iron ore and coal. So coal, for example, you can use to fire electricity plants, right? Electrical plants, right? And then you can also mix iron ore and coal together to make steel. So if you were making steel, you need iron ore and coal. So if you're not using energy, so if you're not burning up electricity, or if you're not making steel to make skyscrapers and factories and cars and all that kind of stuff, you're just not going to need this stuff. Okay? So that shows there's low demand. So if nobody needs this stuff, China is not going to import iron ore and coal from Australia. Now, iron ore and coal happens to be Australia's number one and number two exports. Probably coal and then iron ore. All right. So if China needs iron ore and coal, and they need to supplement their domestic supply of iron ore and coal, they can go to Australia and say, hey, Australia, we want some of your iron ore and coal. So the Chinese can then take their currency, convert it in the open market, buy Australian dollars, and then buy some iron ore and coal. Therefore, demand for the Australian dollar goes up, and the purchasing power of the Australian dollar goes up. The value of the Australian dollar goes up. But now the Chinese buyers own this Australian iron ore and coal, but they got to get it back to China, right? So they need to rent a ship, a Baltic dry bulk ship. So they rent the ship. They put the iron ore and coal into the ship, or ships, right? Probably have different ships, and they ship it back to China. So this Baltic Dry Index now is an index of the price of the ships. So when there's lots and lots of demand for this particular type of ship, right? Imagine just China. If China's booming and Chinese companies, for whatever reason, they need iron ore, they need coal, they need rice, they need soybeans, right? And there's lots of demand. They're competing with each other to get all those natural resources back to China. Well, there's only so many ships. So who gets the ship? Right? When demand for the ships goes up and supply is constant, because you can't just make a new ship overnight, then prices rise. That's what this is all about. If demand for the ship goes up and supply is constant, then price has to rise. It's just supply and demand curves, right? Okay, you got that? So you can use this as a macroeconomic lens. If the Baltic Dry Index is high, so back in at the end of 2014, demand was quite high. What was happening back then? Quantitative easing by every central bank on the planet. What's been happening since? Less quantitative easing by many of the central banks, including the United States. Okay. So back now, 2016, this was down to 300. 300! It was 2,300. Okay? And now it's slowly rising again. Okay? I wish we could get this further back, and you'll have to do your own research, but there's a higher high than that. Okay? So you might want to look at this and say, okay, over the last 5 years, it went from a peak, right? We were at 2,300, down to 300, back to 1,500. Okay? And then look for a currency or a currency pair that maybe has done something similar. What was high, fallen, and then risen again? I think maybe 1 year wouldn't be enough. So if you go 5 years, you can try to get some. And you might want to pay attention to things like commodity currencies. Okay. So yeah, so I've used this. I probably used to check Baltic Dry Index back when it was more important, like 5 or 6 years ago. I think even longer than that, 6 or 7 years ago, when this was way down, and then we were watching it rise back up. Okay, and I think in here we made a call about buying commodity currencies. I can't remember how far back that was. Could have been 2 years ago. I don't even really know. But anyways, it's something to pay attention to. It's really the supply and demand. Well, supply of ships and demand for shipping, right? And because demand for shipping can be up and down quite quickly. I mean, you can get an order today. Hey, we want to buy more iron ore, right? That could just happen now. But you can't just make a ship overnight. It takes quite some time to make a ship, right? So you can argue that the supply of the ship is quite fixed or constant, and demand for the existing ships and available ships, right? So if ships are not available, then prices are going to go up, and you could say, oh, that's going to be good for commodities, but that might also indicate that China is buying or stockpiling. Okay, part of this spike here was China building steel for nobody. They were doing it just to keep the steel factories open, just to keep steel workers employed. So they were just making steel for no particular reason, right? Making ghost cities and stuff like that. And then that's petered off. So anyways, I'll leave it to you now. Okay? I'll leave that to you now. You can go to the Baltic Dry Index. You don't have to use this Bloomberg one, but you can. And then you should go through all your currency pairs and find something that is somewhat similar to this, and then try to do some research to explain why that may have been. And if you go through an exercise like this, you will probably become a better currency trader, because you'll have a better understanding of why do currencies change valuation. How does this relate to macroeconomic conditions and supply and demand? Okay? Plus, you just might find it interesting. So, thank you very much for coming to today's webinar. Please visit tradersway.com and open up a trading account. It could be a demo. That's all right. Get used to our spreads and all that kind of stuff. I think you'll find we're very competitive, and our customer service is awesome, and we're good looking, humble, good looking people. But if you open up a live account, you have to apply. You got to go through the normal due diligence, and then you got to fund your account. It takes some time. Opening a demo takes 1 minute. Funding a live account will take some time. But in a couple of weeks, I'm going to do a series of webinars. I'm calling it a workshop. And it's only for those that have funded live accounts at Traders Way. And I'm going to do an entire workshop on how to day trade. Very, very specific on day trading. So if you'd like to, and it's totally free if you're a client. So you can put in anywhere from, like, I don't know, let's say 50 bucks to 5 million if you want. And if so, you can attend my webinar, my workshop. And I don't know how long it'll be. It might be 3 hours, might be 6 hours. I don't know yet because I'm designing it for you. Okay, so that's cool. So what I'll do is I'll put a little button in the back office of your Traders Way account. And when you click on it, it'll double check that you have a live account. And if so, you'll be let in. And we'll schedule that soon. I just want to let you know if that's what you want to, if you want to attend that, you should start that process now. And at some point, I'll probably sell access, but it's probably going to cost you somewhere between 500 and 1,000 bucks. So if you don't have 500 and 1,000 bucks, why don't you open up a live account today at Traders Way and you'll get in for free. Thank you, Traders Way. So peace on earth. May the pips be with you. May your profits be above average. Thank you very much for being on my team. Don't forget to subscribe and like. It's actually quite important. So I'll see you sometime soon. Cheers. Now I got to figure out how to turn it off, huh? Hang on. Oh, here it is. All right. Take care, guys. Peace.